Every year, a new investment trend takes over the internet. One year it's cryptocurrency, the next it's AI stocks, then it's NFTs, then it's meme stocks. Every trend promises the same thing. This changes everything. This time is different. This is your chance to get rich. But there's a principle that many of the world's greatest investors quietly rely on. It's called the Lindy effect. And once you understand it, you'll never look at investing the same way again. The Lindy effect is surprisingly simple. The longer something valuable has already survived, the longer it's likely to continue surviving. Think about books. If a book has been read for 100 years, there's a good chance people will still be reading it 50 years from now. If a restaurant has been open for 70 years, it's probably doing something right. If a company has survived wars, recessions, inflation, financial crises, and technological revolutions, it has already proven something incredibly important. It knows how to adapt. Most investors spend all their time looking for what's new. Millionaires often spend more time studying what's lasted, because survival is valuable. Imagine two companies. One launched 6 months ago. The other has been profitable for 60 years. Which one has already demonstrated resilience? The answer is obvious. Yet millions of investors still choose the exciting newcomer simply because it is more hype. The rich understand something different. Time filters out weakness. Every decade a business survives is another decade of proof. This doesn't guarantee success, but it dramatically improves the odds. The same principle applies to investing. Many people chase whatever has gone up the fastest recently. Ironically, those investments are often the most dangerous. Prices rise because excitement spreads. Then expectations become unrealistic. Eventually reality catches up. History repeats itself again and again. The dot-com bubble, the housing bubble, meme stocks, crypto manias. Each time, people believed they were witnessing a new era. Each time, many fortunes disappeared almost as quickly as they appeared. Meanwhile, businesses quietly producing products and profits continued growing. Nobody made viral videos about them. Nobody called them revolutionary. But decade after decade, they kept creating wealth. The Lindy effect teaches another important lesson. Durability is underrated. Imagine building two businesses. One grows incredibly fast but collapses after 3 years. The other grows steadily for 30 years. Which one creates more wealth? The answer isn't always the flashy one. Longevity compounds. This is true for businesses. It's true for investments. And surprisingly, it's true for your financial habits. Think about saving money. Anyone can save for a month. Saving consistently for 20 years is different. Investing every month during good markets is easy. Continuing during recessions requires discipline. The habits that survive difficult times are usually the ones worth keeping forever. That's exactly why wealthy people simplify their financial lives. Instead of constantly changing strategies, they find one that works. Then they repeat it for decades. The average investor changes plans every few years. The wealthy often change almost nothing. Another reason the Lindy effect matters is because predicting the future is almost impossible. Nobody knows which app will dominate 20 years from now. Nobody knows which technology will completely reshape the economy. But we do know something. Businesses that have successfully adapted for decades are more likely to adapt again. That's why legendary investors often favor companies with durable competitive advantages. Strong brands, loyal customers, reliable cash flow, products people continue buying year after year. These aren't always exciting companies. But investing isn't supposed to be exciting. It's supposed to build freedom. Here's another interesting example. Gold has been valuable for thousands of years. Real estate has created wealth for centuries. Owning productive businesses has generated fortunes for generations. These ideas aren't trendy. They're timeless. The Lindy effect reminds us that sometimes the oldest ideas remain the strongest. Social media encourages the opposite mindset. Algorithms reward what's new. Breaking news, hot tips, the latest investment trend. But wealth usually grows quietly, without headlines, without excitement, without constant attention. One of the biggest mistakes investors make is confusing innovation with investment quality. An incredible invention doesn't automatically become a great investment. Sometimes the best businesses are surprisingly ordinary. Companies that sell toothpaste, soft drinks, insurance, industrial equipment. They don't dominate conversations online, but they've quietly rewarded shareholders for decades. The wealthy don't ignore innovation. They simply don't bet everything on it. Instead, they build portfolios capable of surviving almost any future. Another lesson from the Lindy effect is patience. The longer you own productive assets, the greater your chance of benefiting from compound growth. Every year you avoid unnecessary buying and selling. You give your investments another opportunity to grow. The greatest investors often succeed not because they constantly make brilliant decisions, but because they avoid making unnecessary ones. Sometimes doing less creates better results. This principle even applies outside investing. The skills that remain valuable decade after decade: communication, leadership, sales, problem solving, critical thinking. These continue producing income no matter how technology changes. Instead of chasing every new trend, millionaires build timeless skills. Because timeless skills create timeless opportunities. The next time you hear about an investment that's supposedly changing the world overnight, pause. Ask yourself one simple question. Has this already stood the test of time? Or am I simply chasing excitement? The Lindy effect doesn't guarantee success. Nothing does. But it reminds us that survival is one of the strongest indicators of future success. Because in finance, what's lasted the longest often has the best chance of lasting even longer. And sometimes, the smartest investment isn't the newest idea. It's the one that's already survived everything the world could throw at it.